Hello everyone. In this part we will talk about the external sources of finance. The external sources of finance, it's the capital which is raised from outside the business. That's why we call it external. And it has two types, short-term and long-term sources of finance. In this part we will talk about only the short-term finance. We've got three examples for the short-term finance. We've got the overdraft, the trade credit, and the debt factoring. Remember that the short-term finance means it's the capital needed for less than a year. Less than a year, it's short term. This is the definition. Less than a year. That's why we call it short term. The first source is the overdraft. The overdraft is considered a bank loan, but the difference is that it's a short-term one. Okay. This allows the businesses to withdraw a sum of money from their account which is greater than the balance of their account. For this reason, overdrafts are usually used only to meet the short-term cash shortage. That's why we always link the overdraft as a source to finance the cash shortage, short-term cash shortage. What are the benefits and limitations of thinking about the overdraft? A key word for overdraft is the word flexible. It's a very flexible source of finance. Why? Because businesses are able to change the amount of borrowing at short notice depending on their needs. It is flexible. So, till now we have three terms that we link together. We link overdraft to the short-term cash shortage to the word flexible. And the limitations, of course, because it is a kind of borrowing, so there is a cost. Okay, the cost of borrowing itself and the interest rate that you will have to pay. Second type is the trade credit or trade payable. For the internal sources of finance, we talked about the trade receivable. Here we are talking about the trade payable. The trade receivables are the ones that you are expected to receive from the customers, but the trade payable are the ones that you should pay. Payable. You should pay to the suppliers on credit. Okay? Trade credit is a source of finance as the supplier is really lending the money for the cost of goods for the length of the agreed credit period. If a business can negotiate longer credit terms with suppliers, it will increase the short-term finance. For example, if a business can buy $5,000 of raw materials and he can do this on credit terms, for example, 40 days instead of 30 days, then this means that the business has $5,000 available for an extra 10 days. Instead of the 30, now they are 40 days. They are available for 40 days. Another way we can make use of trade credit or trade payable is to provide short-term finance is to delay the payment to the supplier. Example, instead of negotiating with the supplier to increase the credit period from 30 to 40, the customer simply takes longer to pay. What are the benefits and limitations of doing so? The benefits, it's an almost, interest-free loan because you are not borrowing. There is no interest rate. So it's an almost interest-free loan to the business for the length of time that payment is delayed for. But the limitations can be any discount offered by the supplier for prompt or early payment will be lost. You will lose the discount that the supplier will give you if you pay on time. Actually, you are not going here in this case to pay on time. You are going to delay, so you will lose the discount. The supplier may refuse further deliveries to the business until the outstanding payment has been made. He will not give you any further raw material until you pay the old ones. If delayed payment occurs too often, like if you delay often, then the supplier may demand the payment even before delivery. He will stop selling you this on credit. So, now let's think about the consequences, at least one consequence for a business of the three possible supplier actions outlined above, the three ones that we were talking about, the limitations. So, what will happen? What are the consequences if any discount offered by the supplier for prompt or early payment will be lost? Of course, lost discount will increase the business costs, and this might have to increase the prices. Businesses might decide to increase the prices to overcome the costs, which makes them less competitive, because lower prices is considered a competitive advantage. In this case, they will lose it. Second, the supplier may refuse further deliveries to the businesses or to the business until the outstanding payment has been made. The supplier will not give the business any further raw material, for example, until they pay the old ones. So this might result in halting the production. It will be late or something like this. So if the business cannot produce goods, then it will not have them to sell, and this could make them lose sales and suffer lower profits because they have nothing to produce, because they don't have raw materials, because the suppliers refused to give them the material. Third scenario, if delayed payment occurs too often, like for you as a business, you keep delaying paying, so the supplier may demand the payment before delivery. What is the result? Of course, this will reduce the cash that the business has to meet its day-to-day expenses. You will not have liquid cash to overcome or to pay for the day-to-day expenses, and you will put all the cash or you will give all the cash to the supplier before delivery. This reduction in the working capital could result in the business needing to look for another source of finance, for example, the overdraft, which is already an extra cost. Third source of short-term finance is debt factoring. We know that although most businesses in the retail sector insist on cash payment for any sales, most other businesses usually sell goods to customers on credit terms, and that is okay. But the problem is if the customers are not willing to pay or are not able to pay on time. In this case, the customers become a debtor to the business and are shown in the balance sheet, as we will learn later, as trade receivables. You are waiting to, or you are expecting to receive this money from the customers. The longer the period of time the business gives its customers to pay, the greater the amount of finance they will need, because all their money is with the customers now. So they will need to look for other sources of finance to be able to meet again and again the day-to-day expenses and other short-term debts. So one solution can be going to a debt factoring company. The debt factoring company buys the debt for a discounted amount. Example, if you have an invoice for the customer, like $10,000, so the debt factoring company will buy this invoice at, let's say, instead of $10,000, they will buy it at $9,000. This is the discounted amount. This provides you as a business with immediate cash. Yes, it's not the full amount, but it's still, you have an immediate cash, liquid cash. The debt factoring company gains a profit because it will receive the full payment from the customer. The debt factoring company will receive the $10,000 and you will receive $9,000. So why would a business think about this? What are the benefits of doing so, although they don't receive the full amount of money? Actually, number one priority goes for the immediate cash that's made available to the business. And also the risk of collecting the debt becomes the factors, not the businesses anymore. The debt factoring company will be responsible for collecting that money from the customer, not the business anymore. You got the money and you're done. Of course, the limitations, as we said, the firm doesn't receive 100% of the value of its debts. These were the three examples of the short-term finance sources. Again, the overdraft, the trade credit, and the debt factoring. That's all. Thank you so much.